Welcome to Revolutionize Your Retirement Radio, bringing you insights and strategies to help you create a magnificent and fulfilling second half of life. Here's your host, certified professional retirement coach and best-selling author, Dr. Dorian Mintzer.
I want to welcome all of you to my fourth Tuesday Interview with Expert series. I'm Dorian Mintzer, owner of Revolutionize Retirement, and I'm delighted to have all of you with us today. So without further ado, I want to introduce our guest today, who's just this lovely person and man, David Holland, who's the founder and owner of Holland Financial, which is a diversified financial services firm located in Ormond Beach, Florida. He's helped over 500 families since starting his firm in 1997 to broadcast his message that retirement planning doesn't have to be hard, complicated, or stressful. He's produced over 1,000 radio shows and written a weekly financial column since 2011. He's the author of 2 books, and he's the host of Plan Stronger TV, which airs weekly on public television, currently WDSC Channel 15 in Daytona Beach, Florida. He's a heavily credentialed advisor holding numerous certifications, CPA, PFS, CFP, COU, CHFC, and CTFA designations. In 2016, David was recognized by Retirement Advisor magazine as one of the top 5 advisors in the nation. He lives in Ormond Beach, Florida, with his wife, Tony, and their 3 teenagers. And I had the pleasure of not meeting in person, but being interviewed twice by David Holland on his radio show. And then I had the added pleasure of going down to Florida and being one of the people on his Plan Stronger TV film series, which was quite a joy, and another joy to meet him in person. So I am so delighted you're with us today, and I do want people to know there will be slides today, and for David, for you to know that not everybody may be looking at the slides, so hopefully you can just help them know that they won't be at a disadvantage. And also when you hear afterwards, people will have the opportunity to have the PDF of the slides. I think that's correct.
Yes, it is. And thank you for having me on, Dory. I really appreciate the opportunity to share with your listeners and viewers and participants some real essentials about retirement and financial planning.
Wonderful. Now, I know that, and David has agreed to stay a little longer. He has some things he wants to present to us about retirement planning, and what are some of the basics that people should focus on? I'm just going to ask questions kind of throughout periodically, but I know you've got your slides, so you can move ahead with them if you'd like.
Sure, and I'll jump around based on how we go through the interview, but my basic concept or philosophy that you shared, Dory, is that retirement planning really doesn't have to be hard, complicated, or stressful, and the financial industry hasn't always done the best job of making it easy. Sometimes language is used that's very complicated, and it seems like another language is not in plain English, and so what we're going to do is as we go through the discussion today, I'll just give one quick kind of compliance thing up front that I'm going to give some general commentary, and so I won't be giving any specific advice, but I will be talking about some of the what I call the retirement essentials. And so let me jump over and dig into this. The big thing is I want to get through.
Before you go on, I'm sorry to interrupt, but
okay.
Donna, I just need you, the same thing happened as last time. Would you go into the questions, and you have to set something up so that I can see the questions? So it's just quicker for me to say that rather than have an email. So thank you. Okay, go ahead.
No problem. Okay, so here are my topics, and I will get to as much of it as I can. But these are some of the retirement essentials. Very often in our haste to want to get to the fun stuff, the investing, and how am I going to get income in retirement, and what's an exciting thing to be investing in today, it's easy to overlook some of the things that require some planning and some very deliberateness or a deliberate approach. And so I'm going to hit some of the things that I've found in my experience working with clients the last 20 years, Dory, that have either tripped people up or have gotten in their way or they haven't spent enough time on. And some of it is really basic. And again, it's not as much fun to work on some of the basic stuff because we want to get to the fun stuff. I want to talk about the importance of having an emergency fund, tackling debt, thinking ahead and planning for long-term care? How do you create income? How do we invest when we're ready to do that? And, of course, how do we keep taxes to a minimum? And then we can take some questions as we go along, and I'll look to you to let me know, Dory, as I hit each subject, some of the things that we can touch on. The things that I want people to keep in mind is that there are some core things that we always should be looking into. So I call this an always strategy. We've got to get the basics right. And sometimes those things, like I said, are a little boring, but we've got to do them right first. So we'll be getting into some of those basics. But one of the things that is often I see when people come in to meet with me and that I'm reviewing maybe where they've gotten some financial advice or maybe been sold something that sometimes I see people where they are in a position of not being liquid enough, or maybe they've invested or done something, or they've taken on debt and they don't have enough liquidity. So one of the first things I tell people is that whenever I'm building a financial plan, we've got to maintain liquidity because, as a lot of your participants know, life happens, right? Things happen, and there's nothing wrong. In fact, it's very prudent to have cash you can get to, have liquidity that you can access to take care of what may come down the road. Now, with that said, the other side of the coin is when we build a financial plan, we make investments, we do things, we also don't want to be semi-committed. We need to commit to what we're doing and stick with our plan so that when we have a market meltdown or we have what is a normal occurrence in the market of a pullback, that we don't panic and we can stick to our plan. So on one hand, I want people to have liquidity and have flexibility, but on the other hand, when you build a financial plan and you look toward the future, you do want to commit and make plans and stick with them, and then, of course, make changes as you go and as you need to for your plan. The other important thing that's an always, I call these my always strategies, is to use money in the right order. When we get to where we're ready to start drawing on our investments or our resources we've saved for retirement, we want to use them in the right order. What do I mean by that? We want to draw money that is invested in a more stable asset or money that we've already paid taxes on first before we start drawing on things that are maybe invested in something more aggressive or something that moves up and down more. So there's a very deliberate approach that people can take to look at their assets and look at when they're going to use them, and keep that in mind that money in a stock account versus money in a bank account are two very separate, different things, and we need to think about and plan on when we're going to use them. The other big one, a couple other big ones, is always consider taxes. Now, I'm a CPA, as you introduced, Dory, but I caution people to be careful to not put taxes, but again, at the same time, don't make all your decisions based on taxes. Consider taxes as part of every financial decision, but make sure that you don't let your maybe, let's call it, distaste for taxes get in the way of maybe making a prudent decision that would be appropriate otherwise. And then the other big one, these are all my always strategies, always watch your fees. Always be cognizant and never invest in something that you don't know exactly what the fees are. If you're working with an advisor, you should ask two questions. You should ask the advisor exactly how they're paid for what they're going to do, and you want that in writing. And you want to know exactly what the fees are for whatever it is that they're recommending to you, and you want that in writing. If you can't get those two things, you need to keep shopping. You need to maybe talk to some other advisors. There's absolutely nothing rude or inappropriate or taboo about asking a financial advisor to tell you exactly how they're compensated, and if you don't get a straight answer on that, then you need to, like I said, keep shopping because the advisor knows exactly how they're going to be paid. And another, go ahead.
No, I was just going to say, so I have questions are starting to come in now, so I just wanted to mention that. But tied in with that, since a lot of people on this call are probably 45 or 50 and older, some point if you could speak to how that should impact on how people think about how best to handle their money.
Wonderful. I'll mention one more thing, and then I'd like to talk directly to that, Dory, and it goes with that age bracket of people you're talking about that are on the call, is whether you are managing your money yourself or whether you're having somebody do it for you, including your 401ks and things like that, you always have to watch your accounts. You can assign responsibility, you can delegate responsibility, but ultimately it's still your money. And you should take a few minutes every month to review your account, look at the statement, open up the statement, even if the market's down, open that envelope, and you just want to make sure there's nothing unusual or something you don't recognize, because it's not a perfect world. Financial people make mistakes. Investment companies make mistakes, so you want to be watching and continuing to monitor. Now, specifically to people that are in their mid-40s to, say, mid-50s, that is what hopefully is going to be maybe a peak earning period. For people that have had families, started families, purchased a home, had various life changes along the way, once people are in that 45 to 55 range, they definitely have retirement on the brain. And they're definitely thinking ahead. Okay, so I'm going to be turning 50, Dory, in 2018. So I'm thinking myself about, okay, I'm turning 50. I'm thinking another 15 to 20 years of work, and then maybe I might ease up a little bit. So I'm thinking about what my retirement is going to look like. I'm thinking about how I need to be investing. So I have a home. My kids are teenagers. They're going to be going to college. But I'm thinking ahead and how I'm investing, and I've learned things along the way. And so I'm putting money in my 401k. When people turn 50, they can put extra money into their 401k. There's a catch-up provision. So it's a wonderful time to be thinking about retirement and what to do to move the ball forward. Now, during this phase of life, there are a lot of things we've done, but there's still things that we need to do. And I'll touch quickly, no matter what phase or stage of life, whether somebody is 20, 30, 40, 80, wherever they are in life, one of the things that is easy to overlook and it's not very exciting to talk about is maintaining an emergency fund. And I know that cash doesn't make any money at the bank sitting in a money market account, but it's important to keep money on hand in case there is an emergency. And the fact that it doesn't earn anything, it's doing its job of sitting there and being available if you need it, because you're going to be committing other dollars for your retirement. You need to know that you can get that money even if it's a bad time to pull money out of the market. So emergency funds are very important. There's different ways of calculating how much. Generally, my approach when I talk to clients is think about the things that can break, think about the things that can go wrong, and you want to have money on hand. Some advisors or experts will say 3 to 6 months living expenses. Another one I like to look at is maybe 5% of total investment assets is another one. Think about what things can go wrong and have that money available. Now, investment money can be a backup emergency account, but we want to have cash we can get to quickly.
It sounds really important to be aware of. And as we get older, I know you're going to be talking about long-term care because we can get to that.
It's good, Dory.
But as
we get older, there are changes that go on in terms of how we allocate our funds. There's a rule of thumb, and I want to make a comment about rules of thumb. A lot of your participants, they may catch something on TV. There's something that somebody's talking about. Well, do this or do that or think about this, and so there's a lot of rules of thumb out there. And what I want to tell everybody, this is really important. Rules of thumb, or what you might see on television, all of those are things to get you thinking about whatever the particular subject is, but don't take it as necessarily gospel for your specific situation. So I'll give you a great example. It's called the Rule of 100. The Rule of 100 gives you a starting point for how much of your money should be in the market versus not in the market, or invested and at risk or not at risk. So if we take 100 and we subtract our age, that will give us how much of the money should be at risk or invested. So if somebody is, for example, 50 years old, that would mean that about 50% in the market, 50% not in the market. 65 or 70, obviously less in the market, more safe. So as we get older, the general idea is to become more conservative. Now, the reason for that is twofold. One, it's because we're more likely to need to use some of the money once we get to 65 or 70 because we may not be working as much, or maybe we're in a phase of having less income and going part-time. Or the other issue is just simply our overall ability to wait for the market to recover. But if somebody is 30 and the stock market drops 50%, it's really a non-event for them because they're so far from retirement needing that money. It's a good time for them to put more money in. But for somebody who is 70 and they're closer to maybe needing that money, that's a very serious issue, the market dropping like that. And then you mentioned the other one, Dory, which is long-term care. As we get older, and especially people get into 60, 65, 70, 75, they get into that older age bracket, there's a greater chance that they may need long-term care, and those funds might be necessary. So throughout this whole process, I like the idea of having an emergency fund, and then there are going to be things that people need to do that are what I call age-specific strategies where they'll need to make adjustments to how they're investing and the types of financial vehicles or insurances they need. The insurance you need at 70 is quite different than the insurance you need at 20.
So you'll be talking about that, I hope.
Oh, we're gonna pick up some speed here. Here we go. The other thing that go ahead.
No, I was going to say one other thing. Just so far, I have a question from Deborah that may relate now, and it may be more when you're talking investments. But since we're talking a little about the market, she just asked. She's from Idaho. Are you expecting a market correction in the near term? How do you sort of think about how things are now and what may or may not happen? What's the rule of thumb for that, maybe?
That's a great question, Deborah. I'd love to answer that, Dory. Am I expecting, let me break it down. Am I expecting a correction? Absolutely. When? I have no idea. Okay. Correct, just for definition for everybody, a pullback is a 5% drop in the market from where it was. Correction is a 10% drop, and a bear market is 20%. So here's what's really remarkable, and you know this very well, human nature, Dory. Our memories are pretty short when it comes to what's happened in the past and how bad things were. I can think back and remember distinctly where I was in 2008. I can remember back what I was doing in 2000, 2001, 2002 during these down periods for the market. It's easy, though, the further we get away from that, to forget how the market can behave. Of recent time with the market, we haven't seen any big drops. A 10% correction or more is actually not an unusual thing. Historically, over the last 100 years, a market correction of 10% or more happens about every 12 months. So a correction, number one, is normal, and number two, it's very hard to predict. Now, from a general outlook standpoint, I'm bullish and I'm optimistic. I tend to be optimistic anyway, but I'm optimistic about the market and the economy. I think a lot of small business activities occurring. You can look around in your particular neighborhood and look at what small businesses are doing. They are the backbone of this country. And you look at the enthusiasm on the part of business owners. They're the ones that are going to invest in the future and hire people. And so I'm optimistic. However, it's very important to remember that corrections and market events often come out of nowhere. And one of the things that's easy to use as an example is if we do get into some sort of conflict overseas, or there's some sort of, heaven forbid, a terrorist attack on U.S. soil. There are a lot of things that can occur that will be disruptive. Something political could disrupt. So there's a lot of things. So I say all that to say this. We always should have a financial plan that anticipates and is built for the possibility of a correction occurring at any time. It's a great question. Any financial plan should have a part of it should consider that something can happen like that, and you want to be resilient. So if somebody's needing to draw money for retirement and they're upon it and they're in it, then they need to not have all their money in the market. And if somebody is, say, 10 years away from retirement, then, I think it's probably okay to look and say, okay, I can stay more invested with, again, that 10-year time horizon. A market correction for me personally, Dory, as an example, as a 49-year-old, I'm not looking to retire tomorrow. So if the market went down 10%, I wouldn't like it, but it's not really going to affect my decision-making about what I'm doing with my investments.
But if you were older, then you would need to step back and say, wait a minute, I'm 70 years old or 65 or 80 or whatever.
Exactly.
And have that in mind, yeah.
Exactly, Dory. And I'll steal a quote from, and I'll date myself here a little bit. There's a great quote from a place you would never expect it, from Karate Kid. And there's the little Japanese instructor says to the student, the best way to avoid a punch is not to be standing there. So so if you are 70 and you're ready to start drawing money out, you need to not be standing there. You don't have your money in. You can have some of your money in the market, but you don't want all of it in the market. And there's a lot of different financial products and investments and different things people can talk to an advisor about what makes sense for them. I'm a big fan of diversification. Having one financial product or investment is not a financial plan. It's one product or investment. So as people think about their investments and their strategies, one of the biggest and most important things to think about, besides the liquidity that I stressed on earlier, is also being diversified. I've never seen it work out for somebody to go all in on any one thing.
Very good advice. So debt, you mentioned debt.
Debt is not a fun topic. And I'll tell you why, Dory. A lot of people get very stressed about debt, and in some ways stress can be a good thing because it can motivate us, but it also can be an incredible distraction. So for anybody right now who is listening to me talk, I want to give them some really good advice about debt. If they have cash that they're looking to invest, they're like, I want to invest this money, and they've got some debt. And if that debt is an interest rate of 5%, 6% or higher, I'm going to tell them what I tell people that come see me. Think about paying off the debt first. When you pay off debt, so let's say somebody's got a credit card. Simple example. Somebody's got a credit card. Say they got $10,000 on a credit card, and they're paying interest on that. But they're thinking about putting some money to work in investments. Or they've got money invested now, and they're trying to decide, do they want to keep it invested, or, hey, am I worried about the market going down? I am going to recommend paying off the debt. Number one, if you're paying 5 or 6% interest, it's the same as making it, but it's a fixed rate. You're for sure going to pay the 5 or 6. Who knows what you'll make in the market? And then the other thing is it's a distraction. It can affect your decision-making when you're investing. I tell people there's bad debt, credit cards, and loans on your investment account. Sometimes car loans can be. And there can be good debt. Housing debt can be good if it's well managed. And sometimes people get a little bit anxious about having debt when they go into retirement. The financial industry and some of the pundits will say, oh my gosh, you should never have debt when you retire. Guess what? A lot of people do, and there's nothing wrong with that. The important thing is just to make sure you manage it, and that it's really about overhead and outflow and being able to handle what it costs you to live when you retire and you're not getting a paycheck and you're now dependent on pension, Social Security, and your investment accounts.
I think that's the part that gets people really anxious when there's no income coming in and living more on that fixed income, and then at 70 and a half having to take the distributions, and it's, will there be enough? Am I going to outlive my money?
Yeah, and that's really where I spend a lot of my time, Dory, is really about cash flow. Again, nothing wrong with having debt. It needs to be managed. There are lots of different ways to refinance, look at different strategies to do that. But the key is to make sure that, and really the best time to do this, of course, is before you retire. Now, I've had people come in and see me and say, David, it's going to be 5 years before I retire. Let's put a plan together. That's great. I've also had people say, David, I retired on Friday, and I'm glad to see you today on Monday. Here's what I've got, and what can we do? There's all kinds of ways people approach this. The sooner we can plan, the better, so that we know what this is going to look like, and you can feel confident about your retirement.
And I guess there's this unknown right at the moment, since we don't know what's going to happen with the potential tax bill, if it will pass or not, and what deductions there'll be or not. And so owning a house may not be mortgage deduction. Who knows
exactly
what's going to happen? Yeah.
And they're always going to be tinkering with the tax code. For the joke among us CPAs, Dory, is that every time they talk about simplifying the tax code, they add 1,000 pages. So it's always going to be something that's tinkered with, and it's always something that I think is going to be complicated. There's this wishful thinking that someday we'll send our taxes in on a postcard. I don't think that's ever going to happen. It'll always be complicated. But you know what? With some focus and attention, you navigate and you make adjustments as you go along, and you're exactly right. It may or may not make sense to have a home or have the mortgage, and people might consider other things. But debt is part of financial planning, and as I said, it's not the most exciting part. I'll move on to some other areas that I know that we want to talk about. You mentioned this earlier, long-term care. Long-term care is a huge issue. over 70% of people over 65 will need some form of care during their lifetime. Huge number.
Right.
70%
for long-term care.
Yeah, 70% are going to need it for at least 3 years. Here's what I suggest for long-term care. Focus on it. Make an active decision. Have a thoughtful process. Consider different options. Don't ignore it. I don't really have an issue, Dory, if somebody says, you know what, I've looked at long-term care and I have decided that I'm going to be in that 30% that never needs long-term care, and I'm going to take my chances. That is fine, as long as it's an active decision. A lot of people will brush it off and sweep it under the carpet and say, we'll plan for that tomorrow. You have to plan it sooner rather than later, because it is based on your health if you decide to buy a long-term care policy. Now, there are multiple ways to address long-term care. You can use investments if you need it. You can use a line of credit on your house if you have a house. That might be a regular line of credit, or there's a type of reverse mortgage that can be used. It's a reverse mortgage line of credit, basically a line of credit that can be used to pay for your care. You can get a traditional pay every year long-term care insurance policy. And then you can also there's some long-term care policies where you make one payment and you're finished. You make one payment, you don't have to make any more payments. Now, there's a lot of different variations or versions of what I just described. What I will stress to people is look at it, evaluate, and get maybe some guidance on what's the best way to do it for their particular situation. What I want to caution people about is to rely on Medicare or Medicaid. Medicare has very limited benefits for long-term care. Medicaid, you have to be broke. Medicaid is a federal program administered by each state, so it varies by state, and you may have people participating from multiple states here, Dory, so I can't really speak to the specifics of a particular state, but long and short of Medicaid is you have to be broke. It's not meant for people with resources. And Medicare are, for a lot of people, not really practical, which means if you don't have a plan in place to deal with long-term care, then you're going to be using your income and your assets you've accumulated for retirement to pay for it. And that can become a problem, especially for couples and especially for women, that if one of them needs care, which often that might be the man first, that then there may not be as much assets left over for the woman who typically lives longer than her husband, and now she's in a real pickle because they didn't plan for long-term care and the assets get used up.
No, I think it's such a major issue. Could you speak a little more about, I've been hearing more and more about this whole idea of reverse mortgage, some kind of line of credit for it. Is that something that is reasonable to think about? Definitely.
So a reverse mortgage, everybody gets tripped up and gets tangled up with how it works, and these types of mortgages have been around for several decades. I think the earliest one was done maybe in the 60s, and then it became more popular in the 80s. And they've been around for over 30, 40 years. A reverse mortgage is a loan, period. There are different types of reverse mortgage, but it's a loan. One of the common myths is that the bank takes your house, it's not your house anymore, and that's all not true. So there's different types, but let's use the simple example. If somebody has a home that is worth, say, $200,000, just for easy math, they can take money out of that home, they can borrow against it, and when they pull that money out, they don't have to pay it back right away. It can sit there, and now there's interest that accrues, but there's no payments. So people can use their equity in their home for whatever they want. One way to do that is to establish a line of credit. You don't owe anything on the home. You establish a line of credit just like you would with a regular home equity line of credit. And so you have this line of credit, but it's a reverse mortgage line of credit, which means that if you need to pull, say, $10,000 on that line of credit. Let's say the line of credit's $100, the home is worth $200. So if you've got a $100,000 line of credit and you need to pull $10,000 for getting some care at home because you need it, then when you pull that money out, you don't have to make payments like you would with a regular mortgage or a loan. So that's the whole point of using a reverse mortgage version of a line of credit is that it can be used and you have control and don't have to pay the money back. Now, when somebody passes away or they sell the home, then that's when the mortgage has to be any debt. It's a lien. So if you've borrowed against your home, just like with a regular mortgage or a regular line of credit, if you sell the home yourself, you sell the home, you pay off the debt, you take the money, and you do whatever you want to do. When somebody dies, the same thing happens, but it's the executor or personal representative who's taking care of that. Home is sold, debt is paid, whatever's left over goes to the beneficiaries. So I like the idea of looking at all these different options, Dory, of long-term care insurance, looking at a line of credit, looking at investments. Now, one of the things I will tell people that is important is that you don't have to go overboard. You want to get enough insurance, or you want to have a solution that's going to take care of most of the things that may come up and help to pay for the cost of care. Home care, assisted living, nursing home. If somebody's getting an insurance policy, they don't necessarily have to get enough insurance to pay for nursing home. Now, my friends in the insurance industry might think I'm crazy by telling you this, but you don't. It's a little bit like when we have car insurance. Most of us don't have a $50 deductible. It might be $500 or $1,000 because we'll take care of some of the small stuff that can happen. So if somebody needs to have care at home, you definitely want to have a plan to take care of home care or assisted living. But if you need to go into a nursing home, then if you've got an insurance policy, that's going to pay for part of it, and then you might use investment money or maybe some of your income you've been receiving from Social Security or other sources that you've planned on to help make the difference. Because if you're in a nursing home, you're not spending money the same way you would be if you were more active and in better health and maybe cruising or doing other things. So just a word of caution about you don't have to go 150% solution, because it doesn't make sense to be insurance poor and not be able to do anything else, and because of you're trying to plan for what might happen.
And I guess it is so individualized and gets so complicated because particularly in a relationship, if two people have different health needs or different ages, it's difficult. And I guess after a certain point, people don't necessarily qualify for the insurance. Do you tend to think about these other alternatives more than even taking out long-term care insurance, or is the long-term care insurance just another vehicle?
Yes, and yes. I call it a belt and suspender approach. I like all of the above, Dory. I like an emergency fund, an investment fund, long-term care policy, maybe a line of credit. But your point is right on the money about this is individualized, and especially when we're talking about couples. It's not unusual when I meet with people that one of them might have a health condition. Now, what's ironic about that is that makes it even more important to address long-term care and maybe to get insurance on the one that is healthy, because think about it. Let's say that you have couple one and couple two, person one, person two. And if the first person has health issues and can't get long-term care but ends up needing care, then you're going to have to either use a line of credit or the investments that they've saved together to pay for that. That may not leave a lot for the other one, which is why they need to have the insurance. Now, flip it around. Let's say it's the one that's healthy who has the insurance that ends up needing care. Wonderful. We have the insurance. That is then protecting or preserving more of the assets to be used by the one who couldn't get insurance. So it's really important when one person in the couple can't get it to have a very vigorous or deliberate conversation about different strategies and have a plan in place to deal with it.
It always comes back to these important conversations that we need to have. It's really true.
And really
for single
does.
people, for people not in relationships, people who've never married or divorced or widowed, what are some of your suggestions on how people who don't have a partner think about this?
I think the same things are going to be very relevant for them. They still need to have plans in place. And you made me think of a specific person that came in. She came in, she's widowed, and she said to me, I'm looking at some different options for long-term care, David. Here's what I'm thinking. Here's where I'm at. Will you help me figure out a plan? And so we sat down and we built a plan specifically to address what she needed to do. It's especially important for people who are on their own, or who have never married or are not in a relationship, and for them to have things in place. And I'm going to share one more thing, and I'm not an attorney. I didn't mention that on the front end of our introduction. I'm not an attorney, but I will share something that I think is absolutely critical for a single person and for couples, but especially for a single person. You've got to have your estate plans in place. There are two documents, and they go by different names in different states in the country, but they are similar. There's two documents: a power of attorney, which is a legal document that gives somebody else the ability to take care of your financial and legal affairs when you can't. So somebody who can step in and pay your bills or file a claim for long-term care insurance. Ironically, when we need long-term care, are we really going to be the one filling out the application? Probably not. So there needs to be somebody who you've given the authority to act on your behalf with your power of attorney. And on a similar note, somebody who has your health care authority. It's called a health care power of attorney or health care surrogate. All these things that we talked about, having these plans in place for long-term care, are only good if somebody else can step in and help you with them, and especially for people who are single or who are not in a relationship. They need to have somebody that, either a friend or extended family member or a professional, and there are professional guardians and professional fiduciaries that people can search and find somebody in their area that will serve in these capacities to help them when they need help to do these things.
And it's so important, I think, at whatever age you are. Hopefully people on the call have these already, but if not, I totally agree with what David is saying about needing this. We just never know when something's going to happen, and we need someone to step in for us or to know what our end-of-life issues and wishes are. That's part of the healthcare proxy or surrogate, as you were saying. And it is different from state to state. Some states it doesn't have to be notarized. Some states it does need to be notarized. So it is important for people to think about that and have that be part of the plan and part of the being intentional so that you've got things in order.
Absolutely.
I do have a question here from Richard from Boston, and
Sure.
It ties in, I think, with just thinking about, particularly, I think, as you get older, issues about where to put your money or how to be, as you say, conservative in not having it all in the stock market. He says, what would you suggest for other sources than the market if you only have 25% in the market? And he says he's 75 years old.
Okay, very good, Richard from Boston. That's an excellent question, and I deal with this every day, Dory. I have a lot of people that are already retired that I work with, or people that are approaching, as we talked about earlier on the call. So for somebody who is wanting to be more conservative, and this will tie perfectly into our next topic, which is retirement income planning, and that is that there's only so many choices really available in the marketplace. The financial industry wants they want to keep the mass in Latin a lot of times. There's a world of choices, and you need to let us talk to you about them. But in reality, there's only so many choices. If we want to be conservative, then we're talking about offerings from the bank, money market, savings, CDs, things like that. Then we have from the investment world, more conservative things are going to be bonds or bond portfolios, bond mutual funds. And then from the insurance world, there are different types of financial products that are more conservative. And the easiest example would be looking at the annuities. And there are different types of annuities. Some are more of an investment, and then some are more fixed in nature. So a fixed annuity pays a fixed rate of interest, and your principal is secure. And you obviously want to work with a well-rated, regarded insurance company. I'm a big fan of looking at those ratings and looking at the financial strength of the company, how long they've been in business. And then also there's a similar type of annuity called a fixed index or just simply index annuity, and that is where your principal is secure, but the interest will vary depending on how the overall market or whatever they're using to calculate the interest. Those are really the most prominent things that I see and often will work with my clients, Dory, is that looking at those safer, more secure investments. Now, as I talked about earlier on the call, I'm a big fan of liquidity. So I'll give you an example. If I were advising Richard, I wouldn't say, hey, let's take all of your money and put it into an annuity. I think that would be a mistake because you're now giving up liquidity. An annuity, you're making a commitment for a period of time, and it's not a liquid investment. Now, by the same token, I wouldn't necessarily say let's take most of the money and put it into a bond fund, because even though a bond fund is more conservative, it still can fluctuate and can go down in value. Even a more conservative bond fund, if interest rates go up, bonds can go down. So back to what I started with, which is be diversified. One of the most important things I can tell your participants, Dory, is not to go all in on any one thing or one source of income. When we hear the life lessons or advice from people that have been extremely successful in the United States, a lot of them will say, I've created multiple streams of income. That's the secret of my success. That's what we will hear over and over. But those are some strategies that can make sense, and how much you put into those more secure things depends on, again, how long it will be before you're going to use the money, and then your individual stomach for risk, how much you can take.
Can you say just a little more about annuity? I know I always get questions about that, and just maybe even just explain to the audience sort of what an annuity is, because oftentimes people say they don't really quite understand it.
For whoever gets a copy of my book, that's chapter 18. I got a whole chapter on annuities, but the short answer on annuities is that there's different types, but the basic concept with an annuity is you are giving money to an insurance company, and they're going to hold that money and then do something with it and give you benefits back from having given it to them. There's an exchange. You give them the money, and then they make a promise to you. And then their promise might be, okay, give us the money and we'll pay you a pension. That's the most basic form of annuity. It's called an immediate annuity. And you put the money in, they will then pay you income every month for the rest of your life. That's a basic immediate annuity. Now, when you do that, they will pay you for your lifetime, but when you pass away, there's typically nothing left over unless you've selected an option that does that, and a lot of times people don't. Now, that's the first type of annuity. The second type is everything else. It's called a deferred annuity. You put your money in, and the money will accumulate for your use in the future, and there's different types. There's the fixed, which is a fixed rate of interest, the index, which is still a fixed, protected, safe money, but the interest is tied to how the market does. And then the third type, which is the one that people need to be careful with about fees, is the variable annuity. The variable annuity it's an insurance product, but it's also an investment product. A lot of people got burned on variable annuities in the early 2000s when the market fell, and also we saw that in 2008 as well. They are a blend between insurance and investments, and they can provide income, they can do different things, but the fees, the single most often surprising situation when I work with people, Dory, where they have an annuity and they're surprised about their fees is with the variable annuity. They have a lot of different moving parts, and the fees can be significantly higher than your average mutual fund. So I just caution people, not that they can't use them or that they are a bad idea, but often they can be expensive, and I do caution people to be careful with them in retirement because they can still be in the market. So I'm personally like the fixed annuities better as a choice. So the thing to know about annuities is, number one, they're not liquid. You're making a commitment. They come in different lengths of commitment, and they come in different types, and there may or may not be fees. The important thing with annuities is to get good advice and make sure that the person is upfront about the cost of the annuity and then also their own personal compensation.
Great. So, of course, it leads my question, but maybe we should keep going with the kind of retirement income, but, how people can find a good person to work with.
You know what? I think that's actually a question that is very worthy of inserting right here, Dory, because I do get a little preachy on this subject, so you'll have to bear with me, and your participants will too. I think it's absolutely critical that if somebody wants to get advice, that they be very careful and very deliberate about finding somebody that will be a good fit for them. And what I recommend people do is to keep a couple things in mind. You have friends and family that know advisors, they can be people you talk to, but don't go just by their own experience. Bernie Madoff committed a scam that was legendary. I think they put it at like $50 billion that he scammed from people. And he did it. Part of it was that people referred him. People were happy and they referred. So just because somebody else has had success with somebody doesn't mean that you necessarily will, or that the person that told you about him is being well served. You don't know. They may not know whether they're being well served or not. So be very deliberate about interviewing and picking. Would recommend people look for people who have taken the time to get certifications, that are licensed, and that you need to also think about, do you want somebody that specializes in one area, that maybe just focuses on investments or just focuses on annuities or just on long-term care, or do you want somebody that can be a little more broader? So you want to know what that person can actually recommend. So there's a lot of important questions to ask the advisor: how you're paid, what are your credentials. You don't have to be a financial expert to get financial advice. I've had people come in and meet with me, Dory, and they're somewhat apologetic. Golly, I don't know what I should ask you, and I'm not sure, and I don't know. And I'm like, look, I'm the doctor. You're not. You tell me your head hurts, okay, then I'm going to run the right tests, or I'm going to give you the right prescription. Everybody on this call has life experiences. If you've met people, you've interacted with people over your lifetime, you get a sense for judging people. There's three essential elements when picking an advisor. You have to like them, you have to trust them, and you've got to believe them. If you don't like them, it won't work. If you don't trust them, it's not going to work. And if you don't believe they know what they're doing, it's not going to work. So you have to get to a point where you feel that way. And so if I were in Boston or wherever your participants are, I would get on the internet, I'd do a search, I would look, now this is a little biased on my part, but I would look for a certified financial planner. That's one of the top credentials. I've held that credential since 1998. It's hard to get. They can go to cfp.net, www.cfp.net, and they can put in the things they're looking for. And they can do a search in their area to find somebody. And I would find at least 3 people, and I would go and interview them, talk to them in person, see how they are, see how their staff is, see where they're located. The other big question is, are they independent? Do they work for a bank, insurance company, or brokerage firm? Anytime an advisor works for somebody, they are an employee. So you have to keep that in mind as they are talking with you about what services they can offer. Are they going to be able to be objective? Are they going to be able to give you advice that's best for you, or will they be limited in some way by their employment relationship? So the most important thing I can tell people about hiring an advisor is don't be bashful about asking questions. This is somebody that you're interviewing to handle your life's work of accumulation of resources. Don't be shy.
Very good advice. All right, keep on then with, I do have some other questions, but let's get into more of the things that you have that you want to cover,
Sure.
And then I'll integrate some of these other questions.
I was going to be talking about, go ahead.
One is related to just what you were saying. So from Sarah from Woodstock says, if people search the net on questions for a financial advisor, do you have any useful suggestions on what keywords to use? Or
Yeah. So some of the ones I just mentioned are really important. The big buzzword is fiduciary, and you need to ask the advisor if they are a fiduciary or not. Will they be serving you in a fiduciary capacity? Well, in plain English, that means will they put your interest first and theirs in their company second? there are different standards of care that financial advisors owe their client. So, for example, if somebody's working in a fiduciary relationship, their job is to do what's best for that client. There are other arrangements or other relationships where the recommendation only has to be suitable. It doesn't necessarily have to be the best recommendation. So the best part about asking an advisor if they're a fiduciary or not is it's a little bit like being pregnant. You either are or you aren't. Okay? So there's no sorta, and so when you ask that question, it should be a yes or no answer. Are you a fiduciary? Yes or no. It's an easy question to ask, and it ties directly back, and I want to make a point about the compensation again. When you're asking these questions and you're looking the advisor in the eye, this has to be in person, and you ask a question, are you a fiduciary? How do you get paid? You should be expecting a direct response that's uncomplicated, not muttered, not vague. It should be, if you hire my firm, we charge you a percentage for managing your money, and here's how that works. It shouldn't be, well, and something off the cuff, something where they're looking away. Pay attention to how the person responds to you. So, are you a fiduciary? Are you independent? How do you get compensated? The other big one of my favorite questions to recommend people ask is, describe to me your process for preparing recommendations for me. Tell me how you do what you do. How do you figure out what you're going to recommend for me? If the person only does, I'll pick on life insurance. If the person only does life insurance, are they going to talk about long-term care and investing and annuities and mutual funds and some of these other things? So you need to be careful and clear about what the advisor's capabilities are. How much latitude do they have by their licensing? What are they licensed to do? And also, if they're employed by a company, what does their employer let them do? If the person can only do one thing or is very limited, then they're either not going to be able to help, or they might recommend what they're capable of doing, not necessarily what's appropriate for the client.
All very important suggestions. Thank you. I think people are finding this really helpful.
I'm glad. The financial world, obviously there's a lot of great people and most advisors want to help, but sometimes this gets a little messy, and the other caution I would give people about working with an advisor is not friend, not family. Don't hire friends, don't hire family. I've seen it wreck relationships. It's not worth it. Hire somebody that you can fire. Because that'll make for cleaner relationships. Nothing wrong with having a friendly relationship with your advisor, but you want to have a professional relationship.
Excellent point. Again, that role in person that becomes so important to think about, because you really are going to somebody in a specific role, and you're, just as you were saying before, it's like a financial doctor in a sense.
Exactly.
And you want to be on a team with them. So I have this other question that came in just to keep in mind as you're talking about some of these other things. And in case people came on late, I just want you to know that David has agreed to be able to stay a bit longer because there was a lot of things he wanted to be able to cover. So for those of you who can stay on, hopefully you will, and otherwise it will be recorded. But this person who didn't identify themselves just says, please be sure that he covers the previous slide on investments. So I don't know the specifics of that question, but probably it makes more sense to you.
Sure. I've got a couple of slides on investments, and I skipped over.
No, the previous slide, I think she said, on investments. Oh, covers the previous slide on investments. Oh, okay, that's what she's talking about.
Yeah, so I skipped over a couple because I wanted to make sure I had hit a couple of things. I'll just quickly go over some of my investment slides and make sure we explain them. Investment observations, there's a lot, of course, that's happened over the last 15 or 10-year period with the market. A couple of things that are very notable or things to keep in mind is that the stock market, and a lot of people look at the Dow Jones Industrial Average, the Dow has tripled in value since March of 2009. And the thing I'll stress to people is I talked earlier about a 10% correction is common. It's not unusual. It may seem like we haven't had it in a while and our memories are short, as we discussed. But bull markets don't last forever. The bull market we're in right now is the second largest and longest in recent history. They do not go on forever, and eventually we will have a change in the business cycle, or something will occur on the world stage that will cause a drop. And we talked about economic growth and things like that. Rates are rising. I don't think they're going to rise quickly. I think it's going to take time to get back to those 5% CD rates. It's going to take a while to get there. The other thing I stressed before about liquidity plays right into investing. Money in the stock market should not be short-term use. If somebody says, I had this question earlier, somebody says, I have $100,000 that I've got in cash, and I know I'm going to need it in 1 year, but I'd like to make some money in the meantime, so can I invest it? If you want to gamble, you can. No, you don't invest money you need in the short term. So you want me to leave it in cash? Yep. You want me to earn nothing? Yep. In other words, you have to remember the purpose. If you're going to need money soon, then you need to keep it in cash. You say, well, I'm not making any money. I understand. That's not its purpose. So there's some different ways to look at it, but the length of time before you need your money is really one of the primary determinants how you should invest. So if you need your money within a year, I'm going to favor cash. If you can look at more of a 5-year period, maybe you can be in a more conservative portfolio. That's going to be a mix of stocks and bonds, leaning more toward bonds. If you can look at more of a 10-year time horizon, or maybe even longer than that, then you can have a more equity-rich portfolio. And again, it's all about it doesn't matter whether you're 75 or 25 or 50. It's how long it's going to be before you need to use the money. And that's why when we get into that back nine of life, when we get into the point where we might need to start drawing the money, obviously it's gotten a lot closer. It's going to be sooner. Now, so people need to think about how long before they need the money, and that will have a major impact on how they invest. Now, the other thing about investing, and I've got a funny quote here, investing is not set it and forget it. I'm a fan of TV commercials. I used to watch the Ron Popeil commercials, and he had his rotisserie chicken cooker, and he and the audience would say it together, you set it and you forget it. But that works for chickens. It doesn't work for investing. You don't set it and forget it. You need to reallocate before, after, during retirement. I had somebody come in just yesterday, Dory. They are retiring at the end of December, and he's got almost all of his money in the market. And my heart jumped to my throat. I'm like, oh, my gosh, what if the market goes through a major drop here soon? That's going to affect his retirement. So we've got to get our money reallocated to be in a position to be used. So if we're close to using it, we've got at least some of it not invested and be available. I talked about hiring an advisor. You asked that question earlier. There's also nothing wrong with investing yourself. I've had people that I've met and talked to and provided some guidance to that actually invest their money themselves. There are 3 requirements or 3 aspects to hiring an advisor: like them, trust them, and believe them. There's 3 things about investing if you're going to do it yourself. You better like it. You better like it. You've got to have the skills, and you have to have the time. I met with a woman recently. She's ready for the story? She's in her early 90s. She's got a very significant investment portfolio. She spends 4 hours a day doing the investment research and managing that money herself. She loves it. So she likes it. She's got the skills. She's done it forever, and she's got the time. She does 4 hours a day.
That's great. Yeah. And she keeps her brain active and taking care of herself in the process.
But I've had people that say to me, David, I've got the skills. I don't have the time and I don't have the interest. I'm going to go on a cruise. You manage my money. And that's fine. You just need to make sure that you know what you're getting into. Now, the other thing on the investment slides that I want to also touch on, and then I'll be happy to take another question, Dory, is we had the question at the front of the call about, do I expect a market correction, and talking about that and how they do happen on an ongoing basis, although it may not necessarily come at regular intervals. You have participants who might be thinking that there is going to be or could be a correction that comes, and the question might be, what do I do? Do I try to go to cash? Do I diversify? Do I try to take a more balanced approach? Do I take money off the table? all of these are options that needs to be considered for each person depending on their situation. I'm very cautionary with people about trying to time the market or going to cash, because if you do that, then of course you obviously have to think about or be able to pick when to go back in, which timing the market is very difficult to do. I do the idea of rebalancing if you need to be a little more conservative anyway. If you are concerned about the market doing a pullback or drop, then and you want to take stock of where you are, I think that's a good thing. Also like the idea of maybe paying off some debt. Let's take some of our gains and use them to pay off some debt. And also diversified, maybe do rental property or look at maybe putting some of the money into annuity for that stability. No, it's always good to be reevaluating where you are.
I think that ties into, I think you've already perhaps answered part of this question, but let me just ask it from Glenn from San Diego. He says, so if you're 70 years old and you need 70% liquid, how do you distribute the other 30%? 20 to bonds, 10 to stocks?
That's a good question. So if we are going to put there's actually two parts to that. I'm going to recommend first that we be more conservative with part of the money. So if we wanted to say 70% is going to be more conservative and 30% would be more aggressive, 70% would go into cash, bonds, fixed annuities, things like that. The 30% would go into stocks or mutual funds or other types of investments, real estate, REITs, things like that, things that are going to be more growth-oriented that can go down in value. Liquidity is separate from that. So you can have 100% of your money liquid, where let's say, for example, we had a portfolio that was 70% bonds and 30% stocks, then I would have a portfolio that is 100% liquid but have 70% that's bonds and 30% stocks. It would be more conservative by nature. So the liquidity piece is separate from the amount of risk you're taking. I'm a big fan of, regardless of how you invest the money, whether it's more stock or more bond or more stock versus less fixed, that we always maintain a measure of liquidity. So let me change it. Maybe we put some money into a fixed annuity. I'm not going to recommend putting, though, 70% into a fixed annuity or any other type of long-term commitment, because I'm giving up so much liquidity by doing that. So in this example, I might take the 70% and put some into bonds, cash, maybe some into a fixed annuity, but I'm not going to put it all into any one thing. So it's all about balance, and so you want to have the right mix of investments based on your age and how comfortable you are with risk, but you always want to keep liquidity as well.
That's part of the emergency fund, it sounds like.
Exactly. It's an emergency fund, and also having money that if you use up your emergency fund, you can still get to your investment money and use that if you needed to.
And how does that relate then to, because at 70 and a half, people have to start taking money out of their retirement savings. Do you have thoughts on that? And
oh, boy, do I ever. Boy, do I ever, Dory. That's a good one to hit before we run out of time. Required minimum distributions, RMDs as we call them. You have to take money out it's actually the year after you turn 70 and a half, but most people start the year they turn 70 and a half, and it's a percentage. It's about 3.8% the first year, and then each year after that, you have to take out a bigger percentage. The whole point of the required minimum distribution is to force you to take money out of these accounts that you haven't paid tax on, so that they can be taxed, and you'll get a 1099 and have to report that as income, and our government gets the income it needs to run. So the important thing to know about required minimum distributions is that they get bigger every year. It's based on the value of your account. And the other thing is that it's required on all of your 401ks, 403bs, IRAs, any of those type of retirement accounts, employer-based retirement accounts, or individual IRAs. They all have to have money taken out. Now, if you have 7 IRA accounts, you don't have to take money out of each of them. You just got to make sure you take enough out to cover what's required for all of them. It's fungible. It doesn't have to be from each one. You can, and that's a common thing that I like to do, Dory, is we might have one IRA, and this goes back to your previous question, we might have one IRA that's invested more aggressively, and we might have a second IRA that's invested more conservatively. Which one are we going to take the money out of for our required minimum distribution? It's going to come out of the one that's more conservative. So we avoid having to take money while the market's down. So these things can all be obviously pulled together and done as part of an overall strategy, and that's what's called a financial plan.
And tied in with sort of some of this financial planning, Murray from Boston asks, what do you think of the possibility of inflation rising along with the interest rates in the near-time future? As elders, is there anything in particular we could do to protect ourselves?
Excellent question. Number one, I don't expect hyperinflation or anything really like off the charts like we saw in the late 70s, early 80s, but I think that we could experience some inflation as we see the economy expand and we see the labor market start to tighten up a little bit. We still have some slack there that's being picked up. People taking higher paying jobs, making room for other people to get back into workforce, and we're still seeing that, but we're not seeing a lot of wage inflation yet. But we will. It's a normal thing for an expansion to see inflation start to pick up. As that happens, I think we'll see interest rates start to come up a little bit. But I don't expect, and this is my professional, personal opinion, I don't expect any fast or large rate increases. Now, with all that said, that means that if we're sitting on cash going, I'm just going to wait for interest rates to go up, we might be waiting a while, so we might want to do some things in the meantime. Not go all in on one thing. Maybe we do some money in a diversified portfolio, maybe with stocks and bonds. Maybe we keep some money in a money market or maybe a short-term CD. Maybe we do a fixed annuity or an index annuity. If the question is, how do I keep my money safe and make as much interest as I can, and if part of that is that it's okay to put that money to work for a period of time and we're not going to need it right away or only need to maybe take a little bit out each year, then I do like the idea of the index annuity. And that's where the money is still a fixed annuity. The money is safe, but the interest is tied to how the overall market performs. So you get part of the market gain without the risk of loss. So it's a variable rate. Some years will be better than others, but you don't lose your interest or your principal. So those are some things that I would think about just to try to hedge against inflation and what interest rates might do.
Great. And another question from Sarah from Woodstock. Has the RMD percentage changed with the changes in longevity since we're living longer now?
Not for a while, but the thing to keep in mind is that could be adjusted in the future. But the thing to keep in mind is that RMD calculation, the percentage you're required to take out, it goes up every year.
Okay. And I have another question. It's not specifically about financial, but I think it relates, and then maybe we can shift a little while we have time to some of the tax planning or other things you want to cover. But Gary from Denver is saying, he just has a kind of comment and wanting your thoughts on it. He says, more and more people are realizing that retirement's a bad idea that pushes people to the sidelines, increases health issues, shortens life, and promotes a wasting of a tremendous resource of talent, skills, and creativity that could continue to benefit our society. What are your thoughts on that?
I've got a one-word answer for that. Amen. I 100% agree. I think that remaining active and involved, and what's ironic about continuing to work, sometimes I'll do financial plan story, and this is good for your participants to know, is I'll do financial plans where people want to know they can retire, and sometimes when we build that plan, they realize they can, then it changes their view on work, and they're like, maybe I'll just work with my employer to make this a little more of a workable, attractive arrangement for me, or maybe they decide to make a shift into something they've always wanted to do. I'm a big fan of the whole encore careers and staying engaged, staying involved, and talked earlier about thinking about my own retirement, and I'm not anywhere near looking at retiring, but I don't see myself getting to a point one day where I go, okay, I'm done, and I never go back to work. I like the idea of maybe a very long taper of remaining involved, and maybe my role changes within my company and the work I do. But it's a great point. And I think that the other thing that is often overlooked is that if somebody's got a job and they like it and they have a good relationship with their employer or their business that they operate themselves, it or make it work for you. And benefit is that you're continuing to accumulate, you're continuing to have income, which means that when you do retire, there's a shorter period of time over which those assets you have accumulated need to provide income. So for every year that you work, that's a year more of savings, and it's a year less that your assets have to provide income. Huge benefit.
I totally agree with you. Being in my early 70s, still working, and my husband is 85 and still working 2 days a week, it's nice to be able to keep doing it if your health permits. And actually, it can keep you healthier.
Absolutely.
But back to some of the other, before we get maybe to some of the tax planning suggestions, other issues about retirement income. The question that just came up is there is a difference, I think, if you're really retiring at the more traditional age of 62 and 65, and then you may live to 80 or 90 versus if you keep working for a while and have additional income and then continue to work. But I guess if you're still working and then you have to take money out, then you're in a higher tax bracket, and it gets very complicated, doesn't it?
It does, and it just requires planning. This goes back to the question about working with financial professionals. This is when somebody has gone through and they've gotten training and additional certifications, and this is what they do. This is the whole area that financial planners work in. I deal with three-dimensional puzzles, Dory, every day, and I build them and then push them forward in time and see what they do. That's what financial planners do. It's not something that that if somebody's had another career, you're a nurse, or you've worked in another field and industry, you don't have to go this alone. It's folks that go through different things that they get advice on, and it helps to have somebody guide you who's been through this process and knows what to look at. And the thing that people are often surprised about is how interrelated all this stuff is. You change one little variable, and it has a big impact on everything, and especially when it comes to taxes. I know you mentioned that earlier, and I've got a few more minutes. We can talk about taxes before we wrap up, but taxes they run through everything, and the thing that people are often surprised that I say about taxes is that taxes should be in the car, not driving the car. You don't want to let your distaste for taxes blur your decisions. You want to make smart tax decisions, but you want to make smart financial decisions. And we all have heard of people who would almost rather lose money than make a gain and have to pay tax. And so there are some things you can do, though, that are smart. And you spoke to this just a second ago, Dory. It's taking money out of your IRAs and 401ks. You have to be careful doing that when you're having income or other sources of income. The IRS doesn't give you a break and say, Dory, you were so good to me last year. You paid me so much in taxes. I'm going to give you a break this year. They don't do that. It doesn't work that way. So every year stands on its own, and the tax is what it is. So I will say that one of the best things you can do when it comes to 401ks, IRAs, and all of that, play along with the required minimum distribution. Take that strategy and embrace it. Draw in retirement when you're at this point in your life, in your retirement phase. Draw from these accounts over time. Draw from them and also draw from other accounts. And use multiple sources and avoid large withdrawals all in 1 year, because it can have an impact on not only your tax bracket, impacts your Social Security taxation, it impacts how much your Medicare Part B premiums are. Those are affected by your income. They are income-based. The more income you have, the higher your Medicare Part B premium will be. And whenever you can, with both IRAs and capital gains, try to straddle a couple of tax years. Do something in December and then do it again in January if you're looking at selling a stock or something like that. Try to not have to have it all in 1 year.
That sounds like really important advice. I'm hearing more, I guess because it's Medicare time, I'm hearing more and more clients talk about the impact that their last year's income is having on the increase in their premiums, and how it just catches them unprepared for that.
It can be a very big impact, and it's a very unpleasant surprise, but there is a chart or a schedule that is used with Social Security. And again, this is the government. They've got all your information, right? IRS and Social Security talks, depending on for example, if somebody's married filing jointly, Dorian, if their income is over a threshold, then they could end up paying quite a bit in Medicare Part B premium. Right. It really runs way up.
Yeah, I was just hearing somebody I was meeting with this morning, in fact. There have been two people recently who actually went to the Social Security office and found it really helpful because they were able to really talk and get some clarification, and both of them were able to reduce some of the money that was being withheld. And one person this morning just said to me, but I was told if I earn $1 over whatever that amount was, I'm going to have to pay another few $100s for premium.
Yeah, it can really feel rather harsh and unforgiving, but it is what it is, and you just have to be smart about it and plan ahead.
This has just been terrific. What other I know I made you jump around a little bit.
What's funny is we actually hit pretty much all of the key information and slides I wanted to make sure we get to. And I'll leave your participants with this story is don't be afraid to ask questions. Don't be afraid to look at different options. And your default position should be stay where you are, stay in cash until you're persuaded otherwise. You got a 401k, you're retiring, you want to roll it out to an IRA, maybe do something with it. Your default position is to hold. Do not jump. Don't feel pressure. And if you experience sales pushy pressure from any financial person, there are a lot of financial advisors out there. You should not have to feel like you're being pushed. And if somebody is on their own, Dory, they're single or widow or whatever their case may be, there's nothing wrong with bringing a friend with them just to listen and help evaluate that they're getting recommendations from. And if you have any concerns or just don't feel good about the situation, there are other choices out there. Don't feel rushed. Don't feel compelled. And if you don't understand it and can't explain what somebody's telling you to do with your money, if you can't explain it to somebody else, you shouldn't do it.
That sounds like really great advice. So, David, this has just been wonderful. Can you tell people how to access your radio shows, or I guess people in Florida that can, and also your books? Tell them.
Absolutely. Everything they can get to me very simply. The website is planstronger.com. planstronger.com, and everything about who we are and what we do is on the website, and everything, books, radio shows, being able to have an appointment with me. I will tell you, by the way, Dory, that we are registered as an investment advisor with the Securities and Exchange Commission, and that means that we can do business pretty much anywhere in the country. We have clients all over. We work with people and can help them over the phone or send them things and email and things like that. So we can help people if they need some help and some guidance, and all that they can get in touch with us. It's all on the website, planstronger.com.
Great. Thank you so much for taking this time and this extra time that you've done and given us today. I so appreciate it. And I so enjoy talking with you every time.
We'll do it again, Dory. I appreciate the invitation. It's been a pleasure, and happy to reciprocate, and enjoyed having you on my television program, and everybody loved it. And for your participants, we do have some of that on the website, and we are working on syndication to be able to bring our TV program to other areas around the country on PBS. So we're working on that, and we'll certainly let you know when we get some more information about that for your participants.
Oh, that's wonderful. And I hope you might come back and join us here again, too.
Oh, that sounds great. I accept.
Wonderful. Okay. Thank you, and happy holidays to you and to everybody.
Right. Thank you very much.
Thanks so much again for taking the time, David. Take care.
Thank you, Dory. Thank you, everyone.
You've been listening to Revolutionize Your Retirement Radio with Dr. Dorian Mintzer. To learn more about the resources mentioned on today's show, listen to past episodes, or download our free retirement transition guide, visit revolutionizeyourretirementradio.com.